Okay, good morning guys. Welcome to spring. And this is the tweet from the BBC. Breaking code red weather warning again in the UK. So this is I don't know where this picture's from, somewhere in the UK, but this is what spring has brought. Happy St. David's Day. As you know, those of you who made it into the office, well done, good effort. Those of you that have not, well, you're snowed in somewhere. But I was just looking, actually, they were reading yesterday, this is the most snow we've had in London since 2009. And I remember it very, very well, because in amongst that snowstorm in 2009, a certain little Amplify Trading was born. We started Amplify Trading in my spare bedroom in the middle of the biggest snowstorm that we'd seen for years. That was in 2009, and here we are. This is the most amount of snow since then. So obviously the UK is continuing to be sort of impacted. We'll see whether this has an economic effect. I mean, it inevitably will, obviously short term. Certainly the weather's got severe enough, and you know, so the disruption could well have a negative impact. Obviously, it's the last thing we could do with at the moment, given that GDP growth is trending lower anyway in the UK, given our inflationary problems and given the Brexit uncertainty and so on. But look, start of the month, that means we've had an end to a month, and let's just check in, because this was an important month, obviously, February, that is now finished. Here's a chart of the S&P, monthly chart, going all the way back to 2010 here. And obviously this big candle up on the top right-hand corner is February.
So next up in 10 minutes. Which
is significant in that it's red. And if I just zoom in a little bit, we haven't had a red candle on the S&P monthly chart. Let me just check here. Yeah, you got to go back to actually, well, March 2017 apparently was a slight down month. But if you look at the cash market, then you got to go down to pre-Trump election. So October 2016 on the S&P cash. For the futures, you got a little tiny red, you can hardly see it, red candle in here on March. But it's been one of the most extended rallies in history, of course, for US equities. Month-on-month gains for the cash market, the longest running set of consecutive positive months in the index's history, going back to the 1920s. But obviously we've ended that run, and it could have been worse. You could argue it could have been better as well. The reason why I say that, if I go to the weekly chart, it could have been worse because we dumped 10% in the first week. And then we had a huge rebound, obviously, so it could have been way worse. In the end, the S&P 500 lost 3.9% in February to make its worst month since January 2016. But of course, it could have been way worse. We were down at 10% at one point. So it could have been worse, but it could have been better. That's because the last couple of days, and the final day of the month, and indeed, the day before, were very negative. We were on a very nice, upward trajectory, continuing the rebound from the collapse. Monday session, we broke up through that high point from the week before, and it was all looking positive, and perhaps we were going to reclaim the 2800 handle, and who knows, maybe even launch an attempt at getting back up to the all-time highs. But actually this has been snapped back now quite sharply. 2 consecutive down days, both over 1% lower. And all of the move yesterday kind of came into the close. It's kind of being pinned on Powell, this move, although the language and comments used were certainly subtle. But I think I guess the long and the short of it is that in the end, markets have felt that Powell could have been more dovish if he had wanted to be. I mean, it's reading between the lines, really. I mean, I'd say that Powell ultimately gave the impression, as quite rightly he should, that stock markets moving lower is not a reason to slow down a rate hiking cycle. And so stocks have come down. I think also you had a bit of China disruption, of course, in terms of market movement, that is, with that sell-off on the 27th of February. But I'll talk about China in a second, because China's had a decent move overnight. Whilst mostly Asian markets are lower, China's bounced. We've had a contradictory reading on manufacturing. We had a bad reading back on Tuesday. Now we've had a good reading on Wednesday. It's all a bit confusing, and anyway, Chinese stocks have bounced, but we'll get on to that. Let's just stick to this February analysis. So stocks down 3.9% when you're looking at the S&P. The Dow Jones slightly more, just over 4%. The Nasdaq slightly less, only down about 1.9% in the end. But let's have a look around some of these other assets just to get a flavour. Now the month of February is finished, and let's look at T-notes. So this is a very important market at the moment, and will continue to be so. This is the daily chart, and this is why it's important, because check out the steepness, if that is a word, the steepness of this sell-off that we've seen in price. So of course, as you know, when prices drop, yields go up. And so as this price has been sharply trending lower, we've had yields climbing. And let me just show you, I'm just going to transition across to the yield chart, because we don't often talk or show you charts of yield. We trade the price, so we're normally looking at charts of price. But here's the yield chart. Let me make that a bit bigger actually by just bringing that out of window. This is the 10-year US bond yield chart, and here we are. As price dropped, yields have climbed, and we're dangerously close to this 3% handle. And the reason why that's important, I think I've told you this before, but it's definitely worth repeating. Well, firstly, if I go back to 2013, then you'll see why 3% is important, and that's because that was the key top back in 2013, December 2013. 10-year yields hit 3%, key resistance, and then we traded back. But more than that, if you go back to a monthly chart, you know, we really are talking about the potential for the end of the 30-year bond market rally, yields trending lower. We've talked about this, but it's worth just saying again. So really this move, this tick higher in yields we've seen at the start of this year, all as a result of stuff you know about, you know, the wage growth data moving higher in the US, inflationary pressures rising. Are the Fed going to hike more than 3 times? Powell kind of at least not dismissing that idea on Tuesday. All this inflationary angst, and then, you know, can corporate America with all their debt afford higher borrowing costs and all the rest of it? So bond yields higher, but 3% would be critical. It would really, if we break 3%, I would say that that confirms the downtrend's done. BlackRock, I saw, were reporting this morning that their analysts, one of their key analysts at BlackRock, think that 10-year yields will hit 4% before the end of the year. What I'm worried about is just how quickly we go from 3 to 4. There's got to be some acceleration above 3% if and when we break it. There's got to be some stops there. That's got to be, and then we got some liquidity concern. And if we ramp to 4% quickly, that'll make things very interesting. You can bet that the S&P will not like that at all. So keep your eye on the 3% handle for US 10-year. Now, what's also interesting, something I was reading this morning, you know, we're talking about long-term yields here, but actually there's a bit of concern on the short end. It's quite an interesting story, and I think one to keep an eye on. So you know about Trump's tax plan. So he got his bill through Congress, and part of that is that corporate America will get a temporary tax relief on repatriating their international cash hoard. So large multinational companies, that's US multinational companies, have got about $2 trillion in cash sat in offshore accounts. Where's this money? Well, it's not sat in cash. A lot of it is they've bought kind of very short-term sort of US Treasury bills, and actually kind of 1 to 3 month bills, which is as close to cash as you can get without being cash. The point is, for these companies to get this cash back home, well, actually first they need to sell these short-term bills, then bring the cash back. So actually, I'm going to show you something. I'm going to show you the 1 month US bond yield chart. This is 1 month. We're right at the opposite end of the spectrum, ultra short term here, and this thing's ramped even steeper. And this thing's rising. You know, it's part of that kind of rate hiking cycle from the Fed, of course. But the acceleration we've seen at the start of this year, and up to 1.5% now. This people are starting to think is perhaps a situation that's being driven by liquidation as part of this big multinational corporation cash repatriation exercise. So this is actually creating a little bit of turmoil in the money markets, and something that needs to be kept an eye on, I think. You know, if you've got 2 trillion out there, and if these companies want to bring it home, you know, in relatively short space of time, then this could lead to interesting upside on short end yields. So keep an eye on this story, I would say, in the weeks to come. But look, this all ties into this concern that you know about, and actually it's quite nice here, Bloomberg coming up with the cocktail of threes, because the S&P level almost hit 3,000, and then of course we reversed lower. GDP growth has been accelerating. And maybe because of Trump's tax cut in the short term, maybe we might see GDP growth accelerate to 3%. We're almost there. The key figure that sent markets tumbling at the start of February, wage growth data, almost hit 3%. It hit 2.9%. And then you got the Treasury 3% handle that I've just spoken about. So you've got this cocktail of threes that's kind of worrying markets. I'll talk in a minute at the end of the briefing actually about what's coming up ahead and what the key data points are, but we do have some inflation data or inflation related data from the US today, so that'll be interesting. But first, back to the charts, because what else has been going on? We're talking about US equities, US bonds, but actually what about the US dollar? And let's start with the euro dollar first. And of course we had a big push to the downside back on Tuesday. You know, Powell's speech definitely helped to get this dollar moving back on the downside. We touched down on the 122 handle overnight, getting this in perspective on a daily chart. This is, you know, back to levels we haven't seen actually since the middle of January. Quite a nice, I mean, if you're into your patterns, let's just draw in a very nice head and shoulders here. Just by the way, let me remove that line. It's questionable what the neckline is. You could probably choose the, well, it's not a head and shoulders, it's a double top, I guess, but it's like a double-headed head and shoulders, because you've kind of got, let me get my drawing tool out that, hang on. I was going to get my drawing tool out.
Which one do you want?
That rectangle one?
Yeah, point it towards the rectangle.
Hang on, guys, wait for it. Here we go. You could say that this is the shoulder, and maybe something in here is the shoulder with a double-headed beast, the beast from the east. And then you could say that this is the neckline here that we're actually testing yesterday. And have we broke it? Have we broken it? So maybe technically this is quite bearish. Well, maybe it is technically bearish, and perhaps thinking about where's the next destination on the downside from a technical point of view, then you're looking at perhaps, if I can get that on the right line, this the high on the 4th of January, which was actually around 121.40 on the futures. So certainly technically this is looking pretty bearish. Yesterday, of course, we broke that low point from the 9th of Feb, so new lows for the month set at the last day of the month yesterday. So dollar strength. After a big period of dollar weakness, it has to be said, of course. Let's talk about cable, though, because this is more interesting. Cable, big move to the downside yesterday. Obviously, dollar strength is part of this story, but it's definitely not the only thing. We broke and closed below the 9th of February low. This is the lowest cable's been since back, same as euro dollar, since back at the middle of January. So a lot of this upside was dollar weakness, of course. Now we've got a bit of dollar strength coming through, but obviously also you've got now this Brexit debate hotting up, and Theresa May, of course, yesterday saying no UK Prime Minister in their right mind would ever agree to this proposal from the EU about having the Irish border moved to the Irish Sea, effectively. I'm sure Ant's covered this already, so I won't go over it. But a bit of a fight back from Theresa May. This is hotting up nicely. We've got an EU summit in 3 weeks. They're supposed to be agreeing a transition deal by 3 weeks' time, and at the moment, it's looking unlikely to get that transition deal agreed. But you know, this is how negotiations go. You get ups and you get downs. I'm sure by the time we get there in 3 weeks' time, we'll probably have a transition deal, because you know what? Theresa May's got no choice, and in the end she's going to have to give in. Whether that topples her leadership is the bigger risk. So definitely things hotting up, which is leading to some risk ramping higher. Brexit risk, so sterling on the downside, and technically, like the euro dollar, really bearish here with that close below that mid-Feb low. So with cable, this really opens things up, and you know, move down below 137, down to 136.50 was the start of Jan high. So certainly the dollar strengthening, the pound weakening. What else? Let's look at oil just before we kind of move on to look at the Chinese data from overnight. So crude oil certainly not enjoying life yesterday with a sharp move to the downside off the build in US inventories. So breaking the overnight low. It got very volatile and pretty difficult. Technically didn't behave itself in the latter part of yesterday's session. It did to start with. Clean break of the overnight low, nice acceleration through S1, S2 being perfect support. Then the rebound came in, a bit of resistance back at S2, but then it got messy. We ramped back up through that overnight low, and then in the end made a push to new lows, and we're kind of still right down there now. So certainly a negative session for oil off the back of the inventory data, but it does mean, if you look kind of more medium term here over the last few months, well then actually oil's just chopping around in the middle of this broader range that we've seen in 2018. And this range is really, I guess it's 58 to 66 is the range. 59 in here as well as the top back in November, a price point of interest, and we're kind of bang in the middle of it. So you know, obviously the dollar strength yesterday also fed into this downside for oil. And if you check out gold, certainly gold's taken a bit of a hit over the last couple of sessions because of this dollar strength play. Perhaps also a bit of hawkishness from Powell, of course, on Tuesday, not helping. For gold, key support down at 1307. That's the double bottom for 2018. 4th of January low, 8th of February low. So it's the double bottom for the year. It's the January low, it's the February low. So 1307, big price to keep an eye on, okay? So this is what's happening. Just quickly update overnight on data. It's a bit confusing. This is what happened on Monday. No, not Monday, Tuesday. We got a really concerning Chinese manufacturing PMI number for February. Sudden drop to 50.3, and as you can see on this chart, that's the worst in some time, at least 12 months. If we go back a little further, it's the worst, yeah, it's the worst for about 18 months. We'd had a real strong run through off the bottom, start of 2016. That's when that kind of global China risk peaked. By the way, that bottom, this Chinese PMI reading in January 2016, that's the reason why the S&P sold off so sharply. And February, the month we just finished, the S&P down 3.9%, which was its worst month since that January 2016 episode of China risk. We've obviously had a nice rebound since then through 2016, 2017, nice tick up through 52. Everything's happy. Global growth at its fastest rate for a decade. But slight drop here, not slight, quite a sharp drop. So this just kind of set the cat amongst the pigeons. However, this is the kind of state level reading. This is the reading for manufacturing conditions amongst the big giant kind of state-owned manufacturers. There's a separate manufacturing reading, which is this one. The Cayenne manufacturing reading. This is more private. This is looking more at the mid to small size manufacturing firms and what are the conditions in that little space in China. And yesterday their February reading was released and it was better than expected, and not only that, it was the best reading for 12 months. So it's a bit weird that on the small to medium sized manufacturing firms you got the best conditions for more than 12 months, just as for the big giant state owned entities you got the worst. Very unusual divergence this, and it's made things a little confused. When you look back on the 5-year chart, this is the best really we've had for 5 years. So a bit confusing, but certainly Chinese equities rallied off the back of this. But the rest of Asia was broadly lower last night off the back of the sharp drop that we had. If I show you that, the sharp drop that we had into the close, if I just get my S&P chart back, if you have a look at your shorter time periods. And then the sell-off came right in the final part of the session. Things were quite balanced before that, in that we were range bound after the Powell sell-off from Tuesday. We were range bound until right at the end. Technical break tipped the balance, and we kind of shifted quite sharply lower. So far today, we've had resistance at the overnight high at 27.22. All right, so that's kind of a bit of an update on what's been happening. Let's have a look at the calendar for today. Let me just zoom in on this if I can. So quite a packed schedule. We've already had that Chinese data from overnight. We've had stuff like Spanish GDP, which came in earlier, and we've had some Spanish PMI numbers, because the interesting thing today, and actually just time check, we're 2 minutes off the German final reading for manufacturing PMI in February. We're expecting it to remain unchanged at 60.3. Okay, so we're about to get that reading very shortly. Then we're going to get the EU reading at 9 o'clock. We've got some UK manufacturing data as well as mortgage and lending figures at 9:30. Then into the afternoon, EU unemployment at 10. In the afternoon, personal income and consumption from the US. That's at 1:30. But more interestingly, the PCE figures, these are inflationary related numbers. Of course, it's all about inflation at the moment, and so these will be the focal point for the session, I would imagine, at 1:30. Jobless claims in amongst that lot as well. And then the big number from the sort of manufacturing side in the US will be the ISM manufacturing print. So that'll be another big number for this afternoon, and that's at 3 o'clock, and we're expecting 58.7, a slight drop from last month. So definitely a couple of important US data points this afternoon, for sure. And then kept busy through the morning with some updates on final readings on EU manufacturing numbers. Okay, so that's your briefing. I'm going to let you get back on it, because we're about to get the German figure right now. Enjoy your sessions, guys, and stay safe. Thanks a lot.